Thank you, Seth. Thank you, Thermo Finance, for sponsoring this event. And thanks to all the other sponsors. And welcome, everyone. Welcome to our viewers. Welcome to the panelists. And without further ado, we're coming at you here from Bohemian Hotel in Orlando, Florida, for this first annual conference, funding conference. So I would like to pass it on to our first panelist, Adam Cox. Maybe he can introduce himself, say a little bit about his background and what he looks for in early stage angel funding. Adam?
Thank you. Our company, Pendleton Capital Group, is a working capital provider of factoring, purchase order financing. We do some equipment lending as well as some inventory lending, which is almost always part and parcel with a factoring line or a trade finance or purchase order finance line. So we're a company that really provides working capital to everything from startup companies that have revenue to our largest client is over 100 million in sales. So we play in that startup to small market space. We don't really specialize in any type of industry, so we'll take a look at almost anything that's out there. We do a little bit of software, but not a lot. We don't do a whole lot of medical, Medicare, Medicaid type stuff. But other than that, we really play in almost every arena.
Thank you for that, Adam. Art, would you like to say a little bit about your company, Digerati Technologies?
Sure. Thanks, Paul. Good morning, everyone. Art Smith here, CEO of Digerati Technologies. I have over 30 years of telecom experience and in the area of international telecom and services here in the United States. Our current venture, Digerati Technologies, is serving the business market with cloud-based communication services throughout the U.S. We have a strong presence in California, Texas, and Florida. And I appreciate the opportunity to serve on the panel. Over the years, this particular venture that we're on today, currently, I should say, and actually we started about 6 years ago, is UCaaS-based, Unified Communications as a Service, very much in the cloud in terms of telecom. But prior ventures have been international scope, even going back as far back as the mid-90s. And we've gone through virtually every type of funding, strategy you can think about there. We've secured equity in various forms, debt in various forms, AR financing, receivable financing. And, I'm eager to talk about that today and give you the perspective of a company that has gone through several cycles of funding its growth strategy.
Okay. Well, thank you, Art. And Brett Atkins, Vice President, Home Trust Bank.
Good morning, everybody. Brett Atkins, Home Trust. I specialize in small business administration financing nationwide for Home Trust. Again, that's SBA financing. And that allows for numerous opportunities for startup financing with a government-backed loan. You think of owner-operator businesses, somebody wants to start a business, the bank will come in and help fund those transactions, anything from purchasing equipment to purchasing real estate to leasehold improvements, inventory, pretty much the whole project. The SBA will come in and back a bank like mine, Home Trust, to help secure the financing for these startup transactions.
Excellent. Thank you very much, Brett. Sure. Okay, so now we'll move on to our first question for the panelist. Adam, if you don't mind answering this first one. When a company is looking for early stage capital, how do most people search for that lender? How do they search a lender?
Thank you, Paul. There's a number of ways you can do it. I think without question, our clients would tell me that the way they find lenders is through colleagues. They'll ask their friends, they'll ask contemporaries. Who do you use? Who do you like? What type of financing are you getting? That type of thing. I think without question, they are asking their friends, colleagues, contemporaries for references on lenders. There's a number of ways to do it. Obviously, people can search the internet. I think that's a dangerous game to play, but people do it. Your banking contacts. A lot of times, if you're an early stage type company and you have a banking relationship for deposits or what have you, those are always good places to go. And your bank, sometimes has contacts with alternative lenders as well. So that's another way to do it. Those are probably the primary ways, Paul.
Adam, you want to add anything to that?
Adam or Art?
You're talking about Art?
I'm sorry, Art. Yes, Art. Would you like to add anything to?
Yeah, I would actually. I think what he pointed out about reaching out to different sources through relationships, I think is references. I think that's key. I believe in getting on the radar screen of your potential lending or funding sources in advance. I'm a big believer in that. I can give you several examples of where we built relationships up to 2 years in advance of when we actually secured the funding with that source. And, it's important to get on the radar screen. It's important for that lender or that investor or funding source, I should say, to track your progress, track your performance. And when the time comes and you're at the point where you could really, just move into a transactional phase with that funding source, it certainly makes it a lot easier because they have a track record. One other thing I want to point out is, what's really helped us is targeting as we go out there and network and talk to different funding sources in advance of needing them, right? As part of our corporate finance strategy and building those relationships, we look for those lenders or funding sources that are familiar with our business, right? That's really important. We've been very fortunate in that, our industry, is just everybody knows everybody, right, in our industry. And you don't have to look far to find lending sources or funding sources for a particular area, whether it's receivables, a bank, venture debt, I should say. So we've been very fortunate in that regard. So that's, I would add to what Adam said by stating that, right? I think that's important. But, network and build relationships early, get on the radar screen in advance of when you need that funding.
Thank you for that, Art. And Brett, anything you want to add to either of those two gentlemen?
Yeah, real quick. So there's lots of resources out there for lenders who provide SBA financing. And there are lots of lenders that are now on the SBA bus, but the problem is not all of them do it well. And not all of them take the time and effort to really understand the business. They're just kind of out there. I wouldn't say pass not money, but they're not really doing the correct due diligence. So look for, the SBA has lots of resources for lenders in your areas that are active in 7A SBA lending, and grill your lender. Make sure they understand, my business model. They're taking time to look at my business plan, understand my needs. That's very important to make sure that you found an SBA lender, but you found one that they do it well and they have experience in your perspective, in your industry that you need financing for startup capital.
Well, thank you for that. That was very informative, Brett. So our next question has to do with what do you as a lender look for with an early stage company? Let's go back to Adam. Again, what is a lender looking for? Let's limit it to the top 5 issues, let's say top 5 reasons that due diligence questions that you look for in a potential deal.
Well, thanks again, Paul. I think this, with a startup company, you're going to go back to what you hear in banking quite a bit, the 3 C's: character, capital, and capacity. We obviously want to meet the owner. We want to know, what their background is, who they are. The character there is key. You're dealing with somebody that is starting a new entity, a new enterprise, maybe even a new career path, and we want to know them and understand them. Their business model is going to be key as well. We want to see what their plan is, who they're targeting, what the market looks like, all that kind of stuff. And then I think the reality is for us, they really have to have revenue for us to provide anything to them. So we're going to want to look at the kind of the core base of who their customer base is. That type of credit quality to us is always key. So those are the main things that we look at, at the early stage with a young company.
Okay, thank you for that. And Art, same question to you. How important is a market, if you can also touch upon that, the market that they're going after or the sector that they're in as well to lending?
Yeah, I think that's really important. In our case, we've always been able to find a financing source or lender that really, that understands our industry. We're very fortunate. There's a lot of lenders that specialize in the telecommunications industry. And I would say that's really important. It not only does it facilitate, getting to, a letter of intent or a letter of interest, it facilitates the due diligence process, right? If they understand your business, it's just going to go so much smoother. We have had a few experiences where a certain type of lender will reach out to us, but may not be as familiar with our industry or our business as others. And it's been a real challenge to, really educate them on certain things that are, just part of our business, right? On how we bill our customers and things like that, right? And how the cash flow streams work. And so I think that's just really, really key. And back to Anna's point about character, I think that's important. Real quick, I want to touch on that. I don't think I've entered into a financing transaction with any financing source that has not first said, I'm betting on management. I'm comfortable with management, and I'm getting behind the management team. And, as we all know, well, as entrepreneurs know, there's good times and difficult times, right? And you want to make sure that you've got a good relationship with that financing source, even especially through the difficult times, right? Because there will be tough times, right? And I think back to character. If they know your character, they bet on the management team, you're going to get through even the challenging times.
Well, thank you for that, Brett. Same question.
Yeah, so I go back to the movie Field of Dreams. If they build it, will they come, right? And on the SBA side, it's all projection based for startups. So I look at it, all right, if they build it, will they come? So the top things that I look for: experience. Do they have experience historically to be able to jump into this new business? Or if they've worked for a W-2 company and they want to go out and do it on their own, do they have the experience? Have they managed certain people, certain budgets, P&L? Can they talk with vendors and suppliers on their own? So that's important. What's your plan? The business plan, I think that came up earlier. That is key. Going through kind of the SWOT analysis. Have you done research in your area? Competition. That old kind of going back to it. Can I talk the talk? Can I walk the walk? And people will buy my product or service. Does the borrower have the ability to inject some capital themselves? Have they saved money? We don't fund 100% of the transaction. Normally, I will fund 80 to 85% of a startup. So does that prospective borrower have some liquidity, some capital to put some skin in the game? And do they have some post-closing liquidity after we do the transaction? Do they have enough personal or business working capital to support themselves in the business going forward? So I don't get that call 6 months later, hey, Brett, I need more capital, I need more money. So I want to make sure the business is set financially, from day one. And I know there's ramp up time. So a lot of things we do is fund the loan with interim interest on a construction phase to help pay that loan, because business isn't open. So we give them about 6 months of time to get the doors open. Then I do interest only going forward. So there's ways the bank can help fund those transactions early on when revenue is not, there's no operation or revenue still is being kicked off. Personal credit is very important. Obviously, these are projection transactions, so I don't have any way to know if the business has performed. So a lot of it goes back to the owner and operator. We like to see good credit scores that they've paid themselves. They have paid creditors personally. Goes a long way for future opportunities, future lending. Projections are obviously key. We want to see, what are you going to do in year one? What are you going to do in year two? What are you forecasting? So projections have to obviously repay the prospective loan to make sure there's debt. We call it debt service coverage. There's enough coverage from the prospective loan to pay the proposed debt. So those are the top things that I look for when a borrower presents a startup transaction to me.
Okay, thank you. So we heard management is very important. We heard credit history, as Brett just mentioned, is extremely important. Collateral is important. How much emphasis do you, let's start with Adam, how much emphasis is put on the business plan for a young, remember that we're talking about young startup companies that may have very little revenue and they have a pro forma sitting in front of you as a lender. How much emphasis do you place on that business plan?
We don't. I mean, we're a little bit different, Paul. We place, some emphasis on the business plan. We want to see that they have a business plan. We want to talk through that plan, but it would be disingenuous for me to sit here and tell you that we think that 90% of our decision is going to be made on that business plan. We really look at the other criteria much more stringently than we do the business plan from our perspective. We not to get off on a tangent, we go back to that character. We go back to something Art said. It really got me thinking about that whole issue of character. We had a client that was starting up a welding company. This was years ago. And came to us. He'd gotten going. He had some receivables. We ran the traps on him. We found out through his application that he had been to prison. Ooh. So here's a guy that has, a track record. We talked through that with him, found out that, 15 years before he had gotten convicted as an 18-year-old young man for selling marijuana and had served like a year in prison. He was upfront about it. We talked through that with him. His credit was really pretty good. It was probably, if I remember, in the upper 700s, maybe even the low 800s. So there wasn't an issue there. It was just the guy had a felony, and he was upfront about it. And we worked through that, and we ended up financing him with his new welding company. And he did very, very well. He was with us for probably 3 or 4 years, and then was able to self-finance it and moved on. So for those that have had issues and have had problems in their background, don't think that you can't find lenders out there that will listen to you, work with you, and understand what you've been through. So I just wanted to give that as a little bit of encouragement to anybody that's had any kind of issues like that in their past.
Okay. Well, thank you for that.
You're welcome.
Art or Brett, anything else besides the business plan, collateral, credit history, management? We talked about market. Besides those elements, is there anything else that's kind of sticks in your mind as a factor that's very important for you to consider?
Yeah, I think if I could add that, I think, and I completely understand what Adam's saying about not having, not placing a lot of emphasis on the business plan. We're on an acquisition path. We've made 6 acquisitions in the last 4.5 years, and I can tell you that every service provider that we've acquired, smaller operators, in Texas, California, Florida, they don't have a business plan, right? So,
right.
But we know their industry. We know. So, kind of on that point, we're on a very disciplined M&A path. We're acquiring service providers that we know that are on our technology stack, that serve the market we serve, the small and medium-sized business. So we go into it again. They don't have a business plan, but we know exactly. We know how they're doing things, right? We understand them. And I'm not a lender, right? I'm not a funding source. I'm buying the company, but we would look at it in the same way that any lender or financial institution would look at it. So I would take a look at, I think this was brought up earlier, to absolutely take a look at the market. If they don't have a business plan, look at what they're doing, look at the market they're serving, find out, why they're serving that market, what they're doing well or not doing well. That's really how we look at it. Fortunately, we serve the same market that our acquisition targets serve, small and medium-sized business, with cloud communication services. So we go in at we know that, right? And that's one of the boxes we check off. So I think understanding their market and their target customer and the profile of that customer, churn rates, attrition rates with that customer base, revenue potential with that customer base. I think all that's important.
Thank you. Thank you, Art. Brett, how about anything else you'd like to add to that list of factors?
Sure. Real quick, the business plan it's very important for us. I don't have financials to look for startup capital when it comes to us. So the business plan is key. And one of the things that I look at in a business plan is who put that together. Did the prospective business owner borrower put together, or did somebody else put it together? Because it means a lot if they can have help to put that business plan together, but I don't want somebody else to do it all for them. I want them to be able to talk about their own projections, their own business plan, their competition. So there's resources out there to help prospective owners with business plans, and projection score is one that's wonderful. But I want them to be able to put these together and talk about the numbers. So the business plan is very important, and for the prospective borrower / business owner to have done the projections and business plan themselves.
So it's almost like if they internalize that business plan so they could speak to you about it contemporaneously without having to search and look for numbers. Is that what you mean?
Yeah. It's more of a comfort level, right? If I'm going to give this business owner X amount of dollars, do I feel comfortable that they are going to be able to do this themselves, and they're not going to have to make 100 phone calls? Hey, I really don't know how to talk to this vendor. I don't know how. So it's more of kind of selling me a little bit on, should I give them the money or not? Do I feel comfortable with them? If they've been in the IT space working for, Cisco, and they want to go out and start their own IT consulting company, can they do it? Right? Do they have the ability, the acumen, the character, the credit, all that stuff to make me feel comfortable based on what they presented? I can't do a lot of industry research. I'm not going to call their former employers and ask them, well, how did John or Sarah do? Right? I'm going by the plan that they are presenting to me. So that's all I really have to go by. So there's a lot of importance and depth, and almost a little bit of salesmanship that has to go in that business plan. Hey, lender, this is who I am. This is what I have. This is what I do. Do you believe in me? And then a lot of that comes from the business plan and just interviewing, talking with the borrowers and the business owners.
Right. Well, thank you for that. Very insightful. Okay. Our next question is, how important is the interest rate when providing early stage capital to a young company? Adam, you want to start it off?
Sure. We're talking about credit cards and personal debt here, right?
Well, the overall rate, interest rate that borrower is going to pay as a young startup company.
Well, let me just talk about credit cards for a minute. I think, I see a lot of this, entrepreneurs will get started with an early stage company, and they'll pull their credit card out and buy a piece of equipment or buy inventory or something of this nature, when, they're really taking a vehicle that's designed for very short-term periods with high interest rates, and using that for something that ultimately ends up becoming a long-term debt, because they've run the credit limit, can't get any more, get stuck. They don't have a plan beyond what their credit card limits or their personal debt limits are. And I think when you start using those types of vehicles before you've really thought out, okay, I'm going to need X amount of debt, is a very dangerous game to play. So I think it's okay to use those types of things, but I think it has to be part and parcel with a larger, broader plan where you've thought out how much debt you're going to need and how you're going to execute on that. I think that's key.
Okay. Thank you for that. Art?
Yeah, look, I think interest rate is always important, right? But more importantly is how is that interest rate structured, right? And I'll give you a recent example for us. A few years ago, we entered into a transaction, a pretty large $20 million financing facility. Obviously, we're further along in our business plan at this point. And we negotiated the interest rate, but the way we structured that interest rate where we could essentially accrue some of it quarterly if we needed to, help with cash flow, basically, a PIK, payable in kind structure has been helpful to us, right? So, I think it's important. You want to get, the lowest cost of capital possible. So the interest rate is key, but how you structure that is also important. And, it's key that you build that into your financial modeling and know what you can do early on. And of course, over the course of the term of the loan, if it's debt. Back to Adam's point about personal debt and credit card. I'm not a big fan of that. Been in a lot of situations where that's probably the only source of funding you have to get by. My basic concept there is early on, if you can, obviously you've got to sweat equity, right? And you don't live beyond your means. You might have to eat beans for a while, but don't live beyond your means, and you might not be able to pay yourself, right? Because you're paying your vendors, right? Taking care of your vendors so you can ultimately provide your product to your end user or customer. So I think you have to do that and make some sacrifices, which ultimately will pay off. As you build a company, building up personal debt that's also a high interest rate can be very stressful on the entrepreneur and his family. And once that happens, it just becomes a big distraction. So I'm not a big fan of that. I'm a bigger fan of reaching out to friends and family for early stage companies. I know we've got Brett that does SBA loans. We've never really gone down that path. What's worked for us is at an early stage of a business venture is to bring in friends and family that know our track record, that have done well with us on other ventures. And that's worked out well, not only for the investor, but for us.
Okay, thank you. We used to call that in the old days eating tomato and mayonnaise sandwiches when you had to scrimp on your payroll. So
yeah, many days like that.
All right, Brett, how about for you, interest rates and their importance?
So the SBA sets a cap on what lenders can charge for all SBA lending, and that's the prime rate plus 2.75. So the highest rates on the 7A is right now it's 6.75 as the max rate that any borrower can be charged. And normally most lenders charge that prime plus 2.75 for startup financing. It's just, they're kind of building in that risk, right? So it's a floating rate, prime plus 275. So on a startup with non-real estate, the borrower can borrow up to 10 years on the 7A. And if it's just real estate, then it's up to 25 years. So if you have a combination of equipment and some non-real estate items, then that would blend your term. So heavier real estate, the longer on the 25-year side, the heavier the equipment, non-real estate, back to the 10-year. And if there's a blend for that. So, and then the projections, the borrower needs to have kind of what I call a stress test, a rate sensitivity in there, knowing that, okay, if prime goes from 4 to 4.5 or to 5, how are my margins? Are they going to be impacted so much that I'm going to have to charge more or whatever? So it is important for the borrower to know. First of all, they know what rate they're going to get up front. I mean, when we propose, they know what your rate's going to be. As far as the spread, prime can always change, but it's good always to make sure that you have that sensitivity, you have that in there. Whatever, in the crazy environment we're in, if prime goes up to 7 or 8, how comfortable am I going forward with this startup business?
All right, great. And just Brett, if we can stay on what Art had mentioned about personal debt and credit card debt, sort of segue into our next question. Many early stage companies fund by credit card or personal debt. Brett, what do you heard Art say that he doesn't like when they go out on a limb like that with credit card debt. How big of a consideration is that for Home Trust Bank?
We prefer them to use an SBA loan for startup transactions. A lot of people just don't know about SBA, that there's money there for startup capital. They just don't know. So they go out and they think of the easiest quick thing they have is unsecured lending, unsecured credit cards, so it is concerning, but sometimes they just don't have any other opportunity or they don't know anything. So I think that's where your local area, I mentioned SCORE earlier, those are local companies that can help you, early on. Just think of, as soon as you have that spark in your mind that, hey, I want to start this business, find resources locally, before you start going out, because credit cards, the interest rates, they can get so heavy and burdensome. And then you're like, oh gosh, I'm sitting on this huge pile of credit card debt, and that's hard to get out of. It really is. So please use the resources local in your area. Call your lender and say, hey, I really want to start this business. I'm really tired of working for my company. I got this great plan, or I'm on my way to patent something. So early on, start those conversations with your local lenders and your local resources on how to access capital, because you really don't want to get pigeonholed into credit card personal debt. It's just hard to get out of, and expensive. Yeah.
Okay. Well, thank you, Adam. Would you like to take that one on? How do you consider personal debt or credit card in one of the CEOs that approaches you for funding?
I totally agree and would echo what Brett was saying there. I see it all too often when you're using those types of vehicles, credit cards. Let's take that for a second. You're buying something and you're turning that into more of a long-term debt, where that interest rate is compounding over 3, 6, maybe even a year. Almost impossible to overcome that. If you're using a credit card to buy something where you can turn it within 15 to 30 days and pay it off, that's one thing. But if you're buying things with that credit card because you're unaware of other forms of debt that you could tap into to make those purchases or utilize that type of debt instead of that credit card, that's absolutely the way to go. When you let those high interest rate vehicles like that compound over longer periods of time, it is virtually impossible to get out of that hole. You're digging such a hole that your options become more and more limited. So,
okay, all right, well taken. Art, anything else you want to add to the personal credit card or debt?
Yeah, look, I think we've covered it. Again, I believe that entrepreneur should, again, just really get down to what they need for the business, what sacrifices they need. I mean, what I mean by that is, again, I said it earlier, you've got to hunker down. You can't live beyond your means. I see a lot of entrepreneurs want to continue a lifestyle they may have had, prior to launching a business, and may not have the ability to do that with the business at the early stage. So, don't do that. Just simply don't do that. Right. And I'd say that's a much better path than accumulating credit card or personal debt, because that'll come back and haunt you. And the other thing I'm a big believer in is, you need the support of your family as an entrepreneur, and your wife and others. And when you get into that situation, it puts a strain on the family, puts a strain on others in your family that ultimately, again, it could become a big distraction when you're trying to build a business, and it just creates other problems that you really want to avoid.
Thank you for that. And that's a good segue into our next question for Adam, which is what should new companies expect from a lender in regards to day-to-day control or oversight of their company? And should they be comfortable giving up board seats, and how important is that?
Okay, well, let's address that in two parts. I think in terms of control and oversight, totally depends on the type of lender, in my opinion. A bank is certainly going to want more oversight in terms of reporting There's certain things that they're required to obtain from their clients, where a lender like us or other alternative lenders is not going to have quite the oversight in terms of reporting, borrowing base mechanisms, things of this nature versus a commercial bank. So there's a wide range of probably oversight that you'll see from one lender to the next. In terms of giving up board seats, lenders typically are not going to require board seats. I've seen it happen before, but typically lenders, that's something you're going to see more with the equity, venture capital, private equity, angel investing. You're going to see that request or requirement of board seats for that type of capital. It's much more common on the equity side than it would be on the debt side. I would tell any entrepreneur, don't be scared if you can find interest, whether that be debt or whether that be equity. It's usually going to be equity that requires you to give up board seats. I think you're really just talking about control here. So they just need to understand that if, it's a 5-seat board that they've started with their company, and the debt or equity provider is talking about giving up 3 board seats, they're not going to have control anymore. If it's 2, they will have control. So they need to understand where the control lies with the board and make decisions based on what's best for them. But I would tell them, don't be scared if it's the right deal for you, the right situation for you that requires you to give up board seats.
Okay. Art?
Look, we're an open book, right? We've always been an open book. A lot of transparency. Our financial partners, lenders, they see the good, the bad, and the ugly, right? That's just the way we operate. And I believe if you pick the right partner, if you pick the right lender, you've done your homework again, you worked this, you've got a plan, and you've worked it in advance, and you end up with the right financial partner. I stress the word, term partner. You should be that way. It should work both ways, right? And again, any entrepreneur that tells you that everything's going to be great and they're not going to go through difficult times is not telling you the truth. It's going to happen. There's going to be difficult times and challenges, and you want to have a lender, financial partner that you can go to with that situation. And again, we're completely transparent. We actually, in our last transaction that I mentioned a couple of years ago, when we secured this facility, $20 million facility, we allowed for oversight, board oversight, and we're perfectly fine with that. But it even goes beyond that, because I talk, twice a week to my lender, financial partner in that transaction. And actually, we've gotten to know each other really well. And I think that builds a healthy relationship both ways. In terms of board seats, I agree with Adam. Lenders typically don't ask for board seats. We will, and I recommend if a company or entrepreneur out there is entering into a transaction and the lender requests board oversight, I think you ought to give it to them, right? But even if you don't have that, you ought to be transparent with that lender, right, about the business and everything that's going on, and build on that relationship and that communication. We will give up board seats. We have given up board seats for equity, and that's pretty common, as Anna mentioned. It just depends on the structure of the deal, where you are in the stage of your development as a company. So you expect that to happen at some point, especially early on, if there's a big risk that either a venture capital, private equity group's taking, in investing in your venture.
Right. Brett, how's the SBA process and regarding this board seat, and is that ever asked in your work?
No, as a debt lender, as a bank debt lender, there's no oversight or control. We definitely just look for active companies, not passive. So that owner operator is there working the business, running the business, we don't do any, or SBA doesn't do any investment transactions. It's all active, operating companies, wholesales, manufacturers. But no, as a debt lender, we're not. There's no board seat. We're just providing the capital for the borrower. SBA does not allow for any covenants either, and there's no financial monitoring with SBA. So that allows our prospective business owners to have the freedom, the flexibility to do what they need with their business.
Right. Okay. So the consensus is with debt, usually no board seats given up, and with equity, usually there is some request for a board presence. Okay, so let's move on. The next question is, when you make a loan to an early stage company, what kind of non-financial resources could they have access to through a lender? What kind of non-financial resources could they have access to through a lender? For example, business consulting, business matchmaking, marketing support, et cetera. Adam, you want to address that?
Yeah, this is an area that we take obviously very seriously. When we take on a client, we've already thought through what kind of resources do we have that we can offer to a new client here that will help them further the business. It could be, do I have a client that has marketing expertise? And the answer is yes. Email marketing, website development, that type of thing that I could offer to a new client when they come on that might help them further their operation. We took on a company that performed construction cleanup and Jan sand type services to commercial buildings a number of years ago, and they were not really a startup, but they weren't far ahead of being a startup. And they needed business. Well, one of our lenders is a commercial real estate company, a REIT, and they own commercial properties all over the country. So, we went to management there and asked, hey, do you have opportunity for a new client that is looking for Jansan type work in commercial buildings? And they said, of course. So we were able to provide a new customer for our client when they came on. I think that type of thing for us in terms of what we do and for other lenders as well is key. I don't think you can just be a lender that says, here is, the money that I'm providing for you, and we expect you to make those payments every month, and that's all I'm going to provide for you. I think you've got to do more than that today as a lender. So I think this type of thing, Paul, is really, really important. It helps differentiate you as a lender, and it's just key as a component to the services that you offer to clients that come on board with you. Okay.
Thank you. So Adam, you probably have quite a bit to say about this since you've been on both sides of the table. Please address this question.
Yeah, Art here. Yes, look, what Adam said.
I'm sorry,
about,
Art. Sorry.
No worries. What Adam said about the differentiator there for a lender that brings those kind of resources, that's really important. I can give you a laundry list of relationships that have come about through our financial partners historically and that have developed into some real opportunities, right? Again, I referenced the most recent transaction that we entered into a few years ago, and they have been just provided us a wealth of relationships out there that have been helpful to us with our M&A strategy. This particular financial partner, Post Road Group, they brought us professionals that have helped us streamline the quality of earnings audit that we do on our acquisition targets. They've helped us with streamline the process with a group that specializes in customer surveys, because we do a customer survey on every transaction that we do, which, by the way, they're funding, right? They're funding those transactions. And then historically, prior to Post Road, with some other lenders, I've been introduced to, I guess it would be considered the business matchmaking, right? I've been introduced to other clients of that lender, right? Right. Or other portfolio companies to that lender that have turned out to become business relationships, revenue producing business relationships. So I believe that's a really key part of how a lender can bring more value. Look, and at the end of the day, the way I see it is, that by that lender helping in that way, they're gonna create more value, right? They're helping themselves as well, because it's going to help the business, it's going to help the entrepreneur, and it's a win-win scenario.
Great. Thank you. Very comprehensive answer. Brett, how do you feel about that?
Well, obviously, with the bank providing the capital, we don't provide any non-financial resources, because that could look like, kind of an affiliation. But we do, and I like for that borrower to have those things done before, or pretty much done before they get to me. I want them to, have met with a business consultant to develop their business plan, develop their marketing strategy, support. When it comes to acquisition financing, now they can work with an M&A advisor to target those businesses, but the bank really doesn't get involved in partnering. But we do. I look at it as part of the deal team, right? The bank's the lender. You have your mentor, you have your CPA, you have your attorney, your consultant. So I look at it as, there's partnerships in this. We just can't really get involved and say, all right, as the lender, I'm going to put together your business plan, or I'm going to help you with your projections. I mean, that's something that a lender doesn't. But again, I go back to SCORE, which is one of my favorite organizations. They're a nonprofit. There's, I think, 400 locations nationwide, and that's what they do. They consult, help you put those things together to prepare you to go to a lender and say, here's my plan.
Now, you're referencing SCORE?
Yes.
Okay. Okay, great. I think our viewers may be more interested in seeing something like that. So, okay. So next question. What benchmarks, Adam, what benchmarks are you looking for in a company that you've provided capital to? What metrics before you provide additional money?
Well, I think, we're certainly looking at revenue and turnover. How many customers do they have? How often have they turned over, the invoices that they've billed? How many cycles have they gone through? We also look at margin. Are they hitting the kind of margin projections that they think they are? What is their gross margin, and are they hitting those types of margins as they had originally thought? Those are key things that we look at. Do they have any type of issues that have happened? If they're a service provider, do they have any customers that they've invoiced that they've got a dispute or something like that on already? And if they do, what is it? How can they correct it? So things like that are really just the basics of what we look at with a early stage or startup company.
Okay. Thank you for that. Art, would you like to address that?
Yeah, I would. I'd like to speak specifically to just what our experience has been here in recent years, and we really monitor this closely. But I think it's important that I know this is more of a question for the lender, but from a company's perspective, I think the management needs to be smart and really manage and monitor, I should say, their debt ratios, right? Debt service ratios. Make sure they're aligned. You just don't want to get upside down there. So we're actually working on a very precise model today now that will help us forecast that as we make acquisitions, as we grow the business. That's important to us as a company, but it's also important to the lender. Again, you don't want to bite off more than you can chew, and you want to make sure you manage that right. And you got to consider that there could be fluctuations in the business that impact those ratios. So I think that's key. I think for early stage companies, I think it's important that the lender look at the customer base, look at how those customers are paying. I've just seen a lot of horror stories where businesses I'm referring specifically to businesses in our industry that have gone out there and started selling successfully, but at the end of the day, they've got issues with customers paying, right? So, they get extended receivables and it just gets out of control. And at the end of the day, that becomes a problem. So I think that should be monitored very closely. Obviously, an AR lender looks at that very closely. So I think that's important, especially with early stage companies, right?
So Art, are you saying that when you say you're building your own model, your own financial model for looking at companies and how well they're doing in your portfolio?
Yeah. So what we're doing, again, we're acquiring other service providers that do what we do in smaller markets, Texas, Florida, California, throughout the U.S. So our lender today is helping us finance the acquisition of those targets. So what we want to be able to do is forecast as we look at an acquisition. We want to be able to roll that into our financial model and say, okay, what does this look like from a debt ratio standpoint if we take down $3 million, $4 million to acquire this target, right? And we want to be able to run different scenarios on that. And then that kind of gets back to, I know earlier we talked a little bit about equity. We want to make sure we balance that out with equity. So again, you don't get upside down on your ratios. You want to stay within a range that's reasonable. And so we're very, very focused on that now and building a model. It's a more comprehensive model, but that's one of the outputs that we have that's really important to us.
That's very interesting. Brett, what kind of metrics do you use when you're looking at early stage companies, and how closely do you follow that over before lending additional tranches?
So we hope that in the early stages, we provided enough capital for them to be set for a while. That's the goal, right? For the startup, working capital, inventory, the whole project cost. We want to make sure they've got what they need. So a lot of due diligence goes into that in the beginning. If a borrower comes back for additional funding, we start off like, what is the need? Is it a short-term need? Is it a long-term need? What happened? Is it good or bad? Do they need more money because they can't pay their employers? Is it money they have so many clients coming in, they need funding for inventory? So what is the need? Is it good or bad? And is it a long-term or short-term need? So those are the things we look for. But when it comes down to giving additional funding for a startup, I usually like to see about a year of revenue. Take a look at the P&L. How have they done? And the topic came up about debt service coverage. At that snapshot, say a year later, and they need an X amount of dollars, can they service that debt based on the existing debt that's already out there? And the proposed debt, can they cover that based on their 1 year of revenue? Ideally, 2 years, kids kind of get you out of that startup phase. But 1 year of P&L really helps the bank say, all right, this is good. Or if it's bad, maybe there's other sources. Maybe it's a factoring, not a bank opportunity. It's a factoring or some of the sort of working capital vehicle that may be better suited than just SBA. So we kind of look at the overall picture. But normally we like to have them out of the gate set for amount of time. But if something comes up, a year of financial performance helps us make a decision on funding additional capital for that company.
Okay, thank you. And just as an add-on to that question, Adam, is a year your benchmark as well, or do you look longer, shorter? How often what kind of timeline do you typically use for something like this?
Yeah, that's a great question, Paul. We really are a high growth working capital type of lender. So we're looking for opportunities where our clients are growing at a much, much faster pace than, say, a bank would be comfortable with. And so we don't really talk about, the horizon that a client might need in order to get more capital from us. We're looking at, who are their customers? How are those customers paying? How is our client performing in terms of the service or the product that they're providing? And as long as those things are in check, we're going to grow with them at a much, much faster rate than what a bank would probably be comfortable with. That's the whole point that they're coming to us for. So, our view of that is going to be significantly different than a commercial bank would be. As far as just benchmarks itself, I wouldn't want to sit there and tell you that I have, something in mind. We look at quarterly financials pretty hard. So we're going to want to see on a quarterly basis a P&L and look at all the ratios that Brett and Art have talked about to make sure that there's something, they're not pulling so much money out of it personally that the whole business has got negative retained earnings now when it shouldn't, but things like that. So, but other than that, we really are just looking at growth itself and what they need in order to continue to, provide those services or products to their customers in an uninhibited way and not miss out on opportunity. I'll put it that way.
Okay. Art, anything you want to add to that?
Yeah, I'm not sure I referenced this earlier, but revenue and EBITDA for what we do, and especially in our telecom industry, is really they're key benchmarks. But it's really more EBITDA, which ties really close to cash flow these days for businesses in our industry or service providers in our industry.
And how about the timeline?
Yeah, the timeline. So look, we go out 2 years on our modeling. We're always looking out 2 years. We're always working off a 5-year rolling plan, which is 2 years of historical, 1 year operating plan or budget, and then 2 years out. And that, we're revisiting that every year. And sometimes, in the middle of the year, if we need to make some adjustments. Fortunately, we're growing at a very rapid pace through acquisition. So we got to take a look at that fairly often, right? Every time we do a transaction, we kind of got to go back to the drawing board and look at the 2-year projections. A good example is, we were working on this model, going out a couple of years back in the fall, but we were about to close on 2 transactions that were going to more than double the size of the company. So we kind of had to go back to the drawing board after those transactions to revisit that and recast the numbers going out 2 years. But 2 years is what we like to look at on a projection basis.
Great. Thank you for that. Okay. Our next question. What should a company's management team look for in a financial partner or funding source? What attributes should a young CEO and a startup company look for in that funding source? Adam?
Well, I think here again, you're going to go back to some of the things we've already talked to, and I think it's healthy for a CEO of a young entrepreneurial startup company, early stage company, to have this conversation with their lender, whether that's somebody like us or a bank, on two fronts. One is, if negative things happen, if I miss a covenant, if something negative happens to my revenue stream, how's the bank going to handle that? And have that discussion with the bank. Have that discussion with a lender like myself. What are the consequences if things go off the rails? Because those things can and do happen. And you want to be able to look at your lender in the face and see, how are they going to handle problems? Are they going to fly off the handle and, say, well, we're going to put you in workout immediately and we're going to expect you to pay the loan back as quick as you can? Or in my case, if a receivable goes bad or a purchase order transaction goes bad, am I going to expect him to come up with the cash to pay me back immediately? Or what are the alternatives? How do I get out of this? So those are healthy discussions to have about things that go off the rails, let's say. And then I think in terms of growth, it's always a healthy conversation to have with your financial partner. If I grow at a high rate, say I'm doubling the business this year, are you going to be able to provide the working capital, for instance, that allows me to be able to accomplish those goals if I hit these targets? Those are good discussions to have with your lenders, whether it's a non-bank commercial finance company like Pendleton Capital Group, or a small regional or local bank that you're getting working capital from. Yep.
Almost like a plan B. What's their plan B?
Exactly.
Art?
Yeah, look, I think the entrepreneur needs to do their homework. I think they have to have a plan going into when they start looking for that financial partner. As I mentioned before, I think that should be done well in advance. I think you need to start networking and building relationships well in advance of when you need that funding source. That's been our approach over the years. You need to evaluate and determine what type of lender do you need, and that'll help you narrow that focus to who you're going to approach, right, and how you're going to approach that lender. That the type of lender depends on where you are in the development of your business, right? If it's early stage, you might want to go to Brett, right, at the SBA, right? If it's further down the road, you might, and you've hit some milestones, it might be a different type of lender, right? That like the one we secured with Post Road Group, which we did not secure until we were about 3.5 years into our plan. So make sure you know what type of lender you need and for your business, for the stage that you're at, and then go source that lender, and hopefully you built some relationships in advance to do that. The next thing would be, I mentioned this early on in the discussion, is look for that lender that knows your industry. That's my top recommendation. If you find a lender that knows your industry, it's just everything's gonna go a lot smoother in due diligence. They're just gonna understand, the type of customer you're serving, how you bill your customers, cash flow, how all that operates. Again, us being in the telecom industry, we're very fortunate. We've got a lot of lenders out there that serve our industry and serve our industry well. So we've got a lot of sources there. And then I think, you want to also, qualify that lender once you've narrowed it down to a few, find out what their sweet spot is, right? Find out, are they going to meet your needs? I mean, you might go to a lender and, you need a couple of $1 million and, their sweet spot's 500,000. They won't do more than 500,000, or it could be the other way around. The lender is, you're too small for the lender. You're looking to raise 4 to 5 million. You need 4 to 5 million, but the lender's criteria is 10 million plus. We had that situation with our recent financial partner in Post Road Group. We established a relationship with them 2 years before we actually entered into a transaction with them. We were just too small. We weren't at the point yet in our terms of size and scale where we could take down a 10 million plus facility. But when we got there and we showed that we performed, and they obviously appreciated the fact that we had gotten to that point over time, we were able to enter into a transaction with them. So I would say those 3 items are really key to, getting a deal done. Because at the end of the day, that's what matters, right? You got to get a transaction done.
Right. Well, that's great advice. Thank you very much for that, Art. Brett, would you like to add anything to that?
Yeah, I think Art was reading my mind. He hit on pretty much everything I was going to talk about. One is, does a lender understand my business, right? I mean, you want to have a partner that understands how, like, if you're constructing a building, does the lender know how to disperse and or pay that supplier or the vendor the equipment? Do they know how do they get your business? Because your business, your funding is it's the bank, right? I mean, if the bank doesn't get it, you can't open your business, you can't start your business. So you need to make sure the lender has the ability, the accountability, the accountability and the ability to get your transaction funded. Size is another important factor. I'm glad you brought that up. Some lenders, for example, we start at 350,000 and SBA's max is 5 million. That's a big range. So if you need 50,000, there's other lenders out there. So there's some micro lenders out there that can help with the smaller transactions. So know the lender what's too big and what's too small. Another important thing too is after your loan is closed, how accessible is the lender when you need help, when you need to call them, when you need funding? Are they picking up the phone? Do you have a portfolio manager who's been assigned to you? If you need help, if you need to change something in your business or additional capital, is that lender going to pick up the phone after you close that initial loan? Do you have a relationship? That's kind of the most important thing. Is there a relationship with the bank post close versus just the lender is like, oh, the transaction is closed, that's it, I'm moving on to the next borrower. So you want that relationship from from cradle to grave, right, from the beginning to the end. So that, I think, relationship is very important.
Okay. Well, thank you for that. Okay, so we have a question, gentlemen, from our audience that just came in, and we'll start with Adam. How big is fraud? How big of an issue is fraud in the in your own business, and how do you see that going forward, Adam?
In asset-based lending, factoring, trade finance, that space, it is the number one issue. When we hear about a company in our space that has gone down, it's usually the result of a massive fraud that's been perpetrated on them. So I'll go back to what I talked about early on in the conference here. That's why character is such a big deal for us. We want to know who we're dealing with. We want to know, what their background is. We want to know, as much as we can about them, because fraud is the number one issue that hits our industry. It's unfortunate today that it happens, but I think any lender that doesn't recognize fraud as a huge risk, I think all of us do. There's no sense in even going down that path. It's just you have mechanisms in place that try to prevent that type of thing from happening. But I will tell you that, if you're talking about somebody that's been trying to figure out and perpetrate a fraud on a lender and has been working on it for years, and we see this, they've been working on it for years, and you're going to make a decision as a lender in a matter of a week to a couple of months, let's say. You're going to make the decision on whether to move forward with them. You can kind of see where there's a gap there. You got a person or a company that's been working on a fraud for a year or 2 years, and you're going to make a decision very, very quickly. It is an issue that you have to be cognizant of, and you have to have mechanisms in place to try and minimize that risk. But even with all that said, it's out there. It does happens on a monthly basis in our industry. So it's a big deal.
Okay. Thank you. Brett or Art, would you like to address that?
I think Adam nailed it right there. I mean, look, if there's intent to commit fraud, and it's going to happen, right? There's the party's going to. I think Adam mentioned they've been working on it for some time. They know what they're going to do. They know how they're going to go about it. So it's going to happen. I think it just fundamentally gets back to what Adam said about character and really that, the management team and looking into them and their background. I think that's super important. It's important to us, but it's also important to us to understand the character, and of the lender, right? And I like to align with lenders that share our core values, and that's just so important, right? Because again, things are going to happen. I think there's diligence. Speaking for the lender, and I know this has been the case with us, is diligence, really good diligence on the customer base and the revenue and the billing and the cash flow, and really tracking. I know that's sometimes hard to do early on, but in our case, when we do an acquisition or enter into an acquisition, there's a lot we look into. Think of it as a mini audit that includes a quality of earnings audit and a customer survey, so we can determine a lot of that stuff. I know we're not a lender; we're buying the company, but it's the same process. I'm assuming very similar process to what a lender should do with a company that they may be investing in, right, or lending to. Look into that customer base, look into the, maybe it's some kind of audit in order to make sure you can avoid any potential fraud.
Thank you. Brett?
Yeah, I think all those points are spot on. I would stress the importance of underwriting in the very beginning, to underwriting not only the credit but the person in a sense. Luckily with the SBA, we do background checks. There's a form out there called the Borrower Information Form, and that's a certification of any background issues. Obviously, we're not the SBA / the government's not going to allow funding for major issues, right? Financial crimes or fraud. So it's important to do a lot of that homework up front, that kind of background review. We have some other things in place with the SBA. We kind of do some background checks and some other things. So, but again, you can only underwrite based on what you have presented. If something happens in the future, obviously you have to deal with it. I'm sure everybody's seeing the news out there. When the PPP money was given out, a lot of companies took that money and they didn't use it for purposes intended. And unfortunately, the oversight was that the oversight of PPP was a letdown. And again, that's a different funding than what I do on the 7A side. But again, it's the SBA. It's unfortunate that a lot of fraud happened, and those clients are going to pay the price for that. It's unfortunate, but on the 7A side, it's the underwriting, the due diligence, the background check. A misdemeanor here or there is, a small misdemeanor here is okay. They have to disclose that, and we have to do our homework and due diligence to make sure that those are minimized, and we're going to give the right person the money at the end of the day.
Okay. Thank you for that. Our next question, what consideration should be given to the balance between debt and equity when seeking funding? So how important is that balance of debt and equity when you're looking at lending money to a company? Adam?
Well, we're a senior lender, so when we take on a new client, if they already have debt, we're going to seek a subordination from that lender. And if we can't get that or a carve out, it's probably not going to be a deal for us. But so I'm probably the wrong guy to ask this question to. But we do want to see, what kind of ratio there is between the amount of money or capital they've put in versus where they are with the overall equity in the business. We will look at that. So we do look at equity. We want to see good retained earnings if they have it. In a startup type situation, I recognize that's tough. You've got initial capital contribution there. Sometimes that's cash, sometimes that's not. So this can be a very difficult proposition for a startup. Typically, you're not going to see some type of debt to equity ratio with startups or early stage because they don't have any debt. But again, we're a lender that's going to come in once they are revenue positive and start providing really a cash flow tool for them to help kind of unlock the margin in those receivables that they have and not have to wait the 30, 60, 90 days that it may take. And we see that all the more often today, especially where we are here in Houston with oil field service companies that build larger energy companies that want to stretch them as long and as hard as they can. We'll help them unlock, that margin in the receivable so they can convert that into more revenue as we go forward. So not to get off on a tangent, but that's kind of my 2 cents on that.
Okay. Thank you. Art, would you like to answer that?
Yeah, sure. So I think the biggest consideration should be given to, what the stage of development for the company, right? Management should look at, okay, where are we? Or the owner should look at where are we in stage of development? If you're at a startup stage, I think we've talked about personal debt and credit card debt. Avoid that by all means. I think Bert's got a good option with the SBA. I personally have not entered into SBA loans, but it sounds like that could be a good option at a startup stage. My preference, our preference has always been to go back to friends and family that have been with you, know your character, know you've had some successful ventures and, can help you with that startup capital. The startup capital is key. Obviously, you can't get going without it. But then, you hopefully are able to kick off your venture and get to a point where you're realizing, your plan, you're making it real. And then I call it operational funding, right? You probably need help with cash flow, right? Just because of the timing of receivables. So you may look at AR, right? Factoring at that point. That could be really helpful, right? With meeting payroll, and just managing cash. Then I think you move into, as you keep executing, you got to look at other debt sources. I'll describe it as venture debt, depending on the type of business you have or your business model, your business strategy. In our case, we entered into that phase a couple of years ago, and we had proven out concept to some degree, but not. I think we needed to do it a little more. We now are, again, as I mentioned, we're at six, 7, 8 transactions, so we've definitely proven concept. But venture debt can be key at that stage. A little more costly. It's not as low cost as bank debt, but it's a firm or a lending institution that's going to take a bigger risk than a bank would take. Then as you execute and you've done well, you certainly can tap the equity markets at that point as well. You want to be careful not to get debt too early because at the end of the day, you got to service that debt. And you want a healthy balance of debt and equity. And maybe as you make progress with your business model, once you've secured some venture type debt, then maybe you can bring in additional equity to kind of even it out on the balance sheet. Then hopefully you get to a point where you're bankable, right? And you got, low cost bank debt that's available to you. And of course, that's going to be less costly than venture debt. And along the way, again, you should, as I mentioned previously on the venture side, you should always tap into the equity markets, right? Especially if you've got a better valuation for your company as you've executed, you certainly should tap into the equity markets. But it depends on the stage. The considerations are key, or the key consideration, I should say, is the stage of development you're in, and have a plan. Lay out that plan over 4 or 5 years.
All right, great advice. Thank you very much, Art. And Brett, with the regard to that same question, how does that? How do you address that same question with regard to SBA loans?
Yeah, so earlier we talked about kind of skin in the game. What is the business owner / borrower going to be able to bring in and kind of share a little bit of that with the bank? Normally for startups, we kind of look at that. It's the 80-20, 80% bank financing, 20% borrower. Versus like if I see an acquisition financing, it's more of a 90-10, right? Because you've got established historical cash flow we can underwrite to. So a little bit less, we call it equity injection. That's equity injection is what the borrower is bringing to the transaction. So normally for a startup, again, 80% bank, which is pretty hefty, I think. So the bank is taking on a lot of the risk, but again, that's why there's an SBA guarantee on these loans, not for just the bank to make the loans to get paid on the guarantee, but just to allow for that business owner, to get out there and start up, right? It's expensive and it's hard for startups. So that's why the SBA allows these banks to make these loans. So, again, and when we talk about equity, we really like to see that borrower, have saved up money and be able to put in 15, 20% of their capital into the transaction. That shows that they have planned for this, right? They prepared for this. They're not just going to the bank and say, I don't have anything to offer, but I need all the money from you, right? So the bank doesn't want to take all the risk. So that we'd like to see a little bit of a combination there. And then I talked about post-closing liquidity. After you put in your equity injection, do you have money left over for rainy day funds, right? Your HVAC goes out, right? You got to cut a check. Have you started your business, but then you have some personal and some business liquidity there to help you in case something does awry. Yeah.
Okay, great. Well, thank you for that. All right. So as we're getting close to the end here, we have one more question from the audience. How often is a client of yours so successful that they outgrow your lending, your facility, your loan? And is that a good thing or not? Adam.
Well, we see this actually quite a bit. And I'll start with, is this a good thing or not? In our mind, yes, it is. We're not a bank, so the money we provide in form of debt is more expensive than what a bank's going to provide. And so the way we look at this is most of our clients will move along with us for a period of time where they're financing the majority, if not all, of their receivables. And what we hope is going on is they're putting the profits as much as they can back into the business so that they can not have to finance 100% of their receivables with us in the long run. And most of our clients reach those types of goals where, they might finance half or 75%, let's say, of their receivables. The other 25% they don't need to, and they don't get charged anything on that. And that helps lower the overall cost of capital to them. We do have a number of clients that move on from us to bank financing, or they move on to, they get, somebody like Art comes along and it's an equity, they're trying to roll up that particular company with a number of others because it's a sector in a market that somebody like Art or another venture capital or private equity firm sees value in putting multiple companies together. We've seen that a number of times with our clients. So I think all of these things are good. It just simply to us means they're growing at a faster rate. They're putting those profits back into the business. They don't need to utilize us as much. And so, that's something that we have to deal with as a company as well. And we do. So we're always looking for new clients because of this. And we view it as a positive thing.
Great. Well, thank you very much for that, Adam. Art, would you like to, we just a few minutes left to go here. Art, would you like to address that same question?
I'll be brief, Paul. Look, every lender we've worked with has been happy to hand it off if, again, they've been outgrown. So they see that as a win. And, I don't know of one lender that can fit, every stage of development of the company in terms of how they, financing for that company. So it's a handoff, right? And that, to me, that's a successful, that means success for that particular lender if they've handed off to another lender that, again, is taking the company to another stage because the company's been successful. Everybody wins.
All right. Thank you. And lastly, Brett.
Yeah, absolutely. Growth is great, but we want to also understand, can they manage the growth, right? They want to make sure that they can manage it successfully and they're not over their head. I've seen some opportunities where you build it, they will come, and they really have come. And you're like, oh my gosh, what do I do? But yeah, the bank loves to get repaid, right? I mean, that's what it's all about. It's getting repaid. The bank wants to see them successful, but there's also times where borrowers move out of SBA and move into conventional. We like to see that happen. There's conventional lenders that will take us out. And those are amazing opportunities. So absolutely, hands down, we like to see them successful. Just to make sure that they're managing that appropriately and taking on the right debt when needed.
All right. Well, thank you very much, panelists. That pretty much concludes our first session of Angel Investors. And thank you very much to Adam Cox, Managing Principal of Pendleton Capital, Mr. Art Smith, CEO of Digerati Technologies, and Mr. Brett Atkins, VP of Home Trust Banks. I am Paul Stamoulis. Thank you. And please stay with us for the next session, which will begin in 15 minutes. Thank you very much. And goodbye from Celebration, Florida, just outside of Orlando, Florida. Thank you again.
Thank you, Paul.
Thank you.
Thank you.
Thank you, Paul.